All right, everybody, I'll be calling Richard from the Plain Bagel in a few minutes, but this time I figured maybe I should test if my audio is working before I'm on the call with him. So could you please let me know if you could hear me? Hey everybody, we're almost starting. I'm just checking up if you can really still hear me, just to make sure, and then I'll ask Richard to say something as well, and maybe you can let me know, like in the comments, hey, we can hear you both.
Hello. How's everyone doing today? Can everyone hear me okay?
All right. Hello, everybody. Welcome to Money Macro Talks. I'm Joeri Schasfoort, an economist, and today I'm talking to an investor, which is people might sometimes conflate the two, but they're actually quite different. As I'm not an investor, but still there's a lot of overlap. So I figured let's get one of the best finance YouTubers on the planet. Hello, everybody. On the stream. That's Richard Coffin. To Money Macro Talks. I'm Joeri Schasfoort. I hope you like that introduction. Can you tell us a little bit about yourself, Richard, and the Plain Bagel, which is your channel? Too, but they're actually quite different.
So a bit about myself. I am a investment professional, practicing investment professional. I work as a fully registered portfolio manager in Canada. And I also run a YouTube channel called the Plain Bagel, which focuses a lot on basic investor topics and education. I talk a bit more recently about headlines and things like that, news items, if you will. But kind of the core content, at least that started the channel, was just really basic information. What is a stock? What is a bond? And focusing on kind of the boring long-term approach to investing as opposed to chasing, speculation and high-risk plays and that kind of stuff. So kind of I don't want to say a counter movement, because there are other content creators who put out great content focus on that as well.
Yeah.
But trying to talk against some of the more sensationalist stuff out there, I guess.
Excellent. So a boring investment channel, but actually
I know, just like the name.
I know that you put out quite entertaining content, reviewing.
Thank you. I appreciate that.
Reviewing films like The Wolf of Wall Street, for example, and putting yourself in the thumbnail in a really funny way.
Yeah, I was proud of that. I don't have the best Photoshop skills, but I was pretty proud of how that turned out.
Do you still do that yourself completely?
Pretty much, yeah. I do a lot of the channel work myself. I've leaned on others in the past, and I do have, fortunately, some kind of contacts to even help with editing. But the majority of videos, it's a one-man show. Scripting, recording, editing, and even thumbnails, which admittedly I kind of throw around or put together very last minute. It's usually the very last thing, at times even minutes before the video goes live. And it's actually, that's probably a part I'll be outsourcing at some point, because it's unnecessary. I'm sure, like we've actually talked about this, like it's unnecessarily stressful when you feel like you can't get it right. Like, and it's such an important aspect that there's someone else who could probably do a better job than me. But the thing is, I enjoy every part of it. At work I do very number focused and things like that. A lot of the stuff with the channel, even though it's the same subject, the editing and stuff, it's a creative side to the topic, so I enjoy doing it. It's kind of a nice balance between what I do for my day job.
Yeah, because you actually do a day job on the side as well. Is that like a full-time thing? Because
full-time job. Yeah,
that's impressive.
Thank you. I'm working after this actually. So, but yeah, so I work. I work for a money manager. So the nice thing is it bleeds nicely into what I do for my channel, because for my job I'm actually managing client money. So I started it off as an investment analyst, then kind of helped make more client-focused decisions behind the scenes, and I'm now kind of more front-facing, but the majority of my work is still the research side. So doing investment analysis for the other portfolio managers to help kind of support the operations. But it's nice because, for YouTube, you have to research, or, well, you should research the topics anyway. A lot of the time, what I do for my work, because I actually help with communication pieces for my company as well, a lot of the time that lends itself to a topic I can then cover in a video. And usually, the stuff that clients are thinking about at my work are what viewers might be interested in seeing a video on the Plain Bagel. So so far it's worked. It is a lot of effort to hold up both, but I like doing both.
Yeah, okay. I didn't realize that. I think, that makes total sense. And so you're an analyst for your firm, and others basically make then investment decisions based on your research, which is great since we all love the Plain Bagel, of course.
Yeah, the funny thing is I'm one of the, I don't want to say one of the only, because there are plenty of people who do this, but while a lot of other big finance channels talk a lot about specific companies, I actually avoid that, even though that's what my day job is. I don't talk about stock picks or anything like that. And that's really just because, there's a number of reasons. One is compliance. It's very hard to have a full-time job as an analyst and to basically do that online as well, because there's a lot of liability and stuff when you're fully registered as a portfolio manager. Basically, you can't give broad recommendations out. You kind of are held to a higher standard. But on top of that, it's kind of like the teach a man to fish, kind of lesson. I could just throw out picks and people could just take them at face value, but I don't think there's a whole lot of value in that. I think a lot of people are better suited to, learn the basics themselves. And if they want to research stocks, great, then do that research. If you don't want to research stocks, great. There's passive investing options out there. Me giving you positions isn't going to make you a better investor, I guess. So funny enough, I'm one of the few that completely avoids that.
Yeah, okay. So I see. Yeah, your channel is mostly educational, and now that makes sense as to why you do that. But I do hope that I can ask you a couple of questions then today
Yeah,
about what you usually don't talk about.
Yeah, I'm happy to chat about it, and I've said before, like I don't, I won't be giving recommendations, but I'm happy to talk about the approach and all that, and I'll always just be upfront if there's something
Yeah.
legally I can't talk about. But other than that, like it's I don't talk a lot about my process, so I'm happy to chat about it.
Awesome. What a scoop. And you don't have to worry too much because I'm an economist, right? So what I care about is currencies, countries, central banks, right? I don't really care too much about individual companies.
You're not going for the stock picks? You're not going for the hot takes?
I am not. No, I'm not.
Okay, well, that's good.
No, I'm not. Yeah, I did invest because people, like I mentioned in the beginning, like people conflate it too often, right? Oh, you're an economist, you must be an investor as well. Or even some people say like, oh, you can only be a good economist if you are an investor. So I did invest a little bit on my own behalf, and actually got burned once or twice because I applied economic theory incorrectly, which I'm sure we'll get to. But before we do, I just wanted to talk to you about something which is a shared battle of ours. I think we are both at the moment somewhat involved in a battle to fight sensationalism, or in other words, to fight the thumbnails with the big red arrows down and everything is collapsing. Right. What's your take on this? Because I know you have talked about this on Twitter and on other platforms before.
Yeah.
What are we seeing?
So it's kind of the tricky part of YouTube, right? The reason why people put that stuff in their thumbnails because it does well. The algorithm rewards that kind of sensationalist stuff because it's the same thing with, everyone knows about clickbait in general when it comes to articles. An article with a very captivating or a title that elicits some sort of strong emotion is more likely to lead to a click or someone to read it than something that gives a very plain and leveled analysis of that thing. And unfortunately, with the past few years, with GameStop and the pandemic, which kind of made a lot of people focus more on investing than they might have before, which there are great aspects to that. But also drew a lot of attention to those types of headlines that maybe in the past people wouldn't necessarily be as interested about a story about, why the stock market's going to crash in 2 months or whatever the title might be. My own view, my own view is I understand why it happens because of what I said. If you're a YouTuber, I get that you're going to try and do well for your channel and do the tricks that it takes to get there, whether that be clickbaity titles or clickbaity thumbnails. What sits wrong with me is because I'm investment focused. I know that when it comes to investing, emotional responses is kind of your core enemy. It's actually one of the main detriments that people face when investing is their shortcomings from an emotional standpoint. There's so much academic literature that shows just how terrible we are at investing and how a lot of that, not all of it, some of it is more cognitive, but a lot of that is tied to emotional responses. So it's funny because that same approach to marketing videos is sort of the core evil, I guess, of people's personal investing and why they don't necessarily do well. So to me, I personally wouldn't want to push titles about how the market's going to collapse because I know that might make people make poor investment decisions.
Yeah. So
that's kind of my view from it. Yeah, sell or sell at the bottom, right? That's kind of the what it could elicit, if you will.
But
so that's kind of my main thing.
You are a YouTuber. You're a successful YouTuber. Do you do a little bit of clickbait from time to time?
You know what? I genuinely try to avoid it. It depends how you define clickbait, I guess. I've done more like, I do focus on marketing. There are times where I think, there's probably an arrow in a couple of my thumbnails. Usually what I try to do though is I base that on what I'm actually discussing. So if I'm talking about GameStop, for example, I'll show the price chart for GameStop or the GDP chart for a country that's seen a decline, as opposed to just, I avoid flames. That's my big one. So, and that's the thing is I try not to be too, you don't want to get on your high horse and talk about how everyone is doing this evil thing or whatever, calling it evil. There are ways to make an attractive thumbnail and an interesting thumbnail. You just don't want to misrepresent the situation. And especially go to that extreme where you're sensationalizing something as being the end of the market, or the demise of something that could elicit that knee-jerk reaction of selling everything or whatever have you.
Yeah, but so what I think maybe I actually do a little bit more of it than you do. So for example, in the last video that I posted, which was rather successful, I did use flames, but in an ironic way. But still, I also said like, no, China's economy is not going to collapse. Which is, I think, if I remember sort of my days as an academic, the paper title would have been different. It would have been, I think it's rather unlikely, this scenario that's being sketched by these YouTubers that says China will totally collapse, right? If you catch my drift.
Yeah. I think like I think what matters is qualifying your message, right? It depends on what your assertion is, and whether, like, the term clickbait usually means that you're misleading someone. So, if you were to post a thumbnail that said, "I can't believe so and so died," and then your video is about how that person isn't actually dead, that's kind of clickbait because you're misled viewers. If your belief is what you're saying in the thumbnail or the title of the video, I don't think that's clickbait. You can make that interesting and captivating. To me, the line is when you start misrepresenting stuff, and especially when even if you believe what you're saying, when you start to get into more sensationalist stuff, like, this will surely be the end of this thing. One thing I've always tried to do is qualify statements as to what's an opinion and what's a fact. You can say you have an opinion about whether it be China's economy. You could say, it's my opinion, they're in a really tough situation.
Mm-hmm.
I think if you do that, though, you have to recognize, your own, and this is important, like your own qualifications for making that claim, right?
Mm-hmm.
There are plenty of people who probably shouldn't be making that claim because they don't have the qualifications to back it up, or the research to back it up. So just being cognizant of where your expertise is and what's an opinion versus fact. I think if you navigate that all fine, I think it's important to talk about these things, right?
Yeah.
But it's kind of like the channel name, right? I usually opt to be more boring than than anything else.
Yeah, and I do think that the people who watch you regularly, I scrolled through your comments from time to time. They love that about you. So I think it's part of your channel now as well.
It's found a nice niche.
But one thing that before we move on to using macroeconomics for investing, already starting to go a little bit into the macroeconomics, is I actually think, because yes, I think the bit with clickbait and getting clicks is very important on YouTube, but I do think that the macroeconomy has become more storm-like, in the sense that, like, it's very, it seems like we've been, and I've talked about this with my last guest a little bit, Professor Bezemer, in this sort of perfect storm for now, maybe ever since the Great Recession, I think you could say. And I wonder, so I think there are a lot of people that are casual investors. They watch YouTube and they say, well, my gut, let me make this a little bit more fair. They look out to the economy and they see all of these people getting rich by owning a house, more so than by earning through a normal job, right? And they see crypto millionaires overnight, whereas they don't actually make something, right? They make more than a teacher who seems to be more valuable to society. They see a central bank that's doing unprecedented actions, interventions in financial markets. So I understand where it's coming from, and I think there are also a lot of academics that are actually worried. And I wonder, what's the sentiment like in the investment community?
In terms of like consensus views, some people are mixed. On the one hand, to your point, it's not to downplay we do face real risks, and that's the thing to recognize, right? Mm-hmm. It is a risky economy in terms of the pulling back of stimulative measures that have been in place since 2008 in the U.S. primarily. We do live in a very precarious situation, so there are a lot of investment firms that might be reweighting their different sectors and things like that. you don't see, or at least I haven't seen, based on our research providers and stuff. And to be full disclosure, like I work in Ottawa. I'm not a leading bank Wall Street analyst, so I'm not there talking to Goldman Sachs and J.P. Morgan, on my coffee breaks. But we do get research from a number of different providers, and the high economic view, a lot of them aren't painting a picture of total demise. A lot of them are really just doing moderate reweightings, which genuinely I think is usually in the investor's best interest. When times are scary, a lot of investors, they kind of look at it as like a all or nothing. You're either fully invested or you sell everything and hold in cash for a bit. And depending on your specific situation, that might be appropriate. Say if you need to buy a house in a year, all that money is house money, then it might make sense to sell everything, because you don't have the risk tolerance to wait another year and see where you are because you have this upcoming bill, if you will. For a lot of people who are investing longer term, it's, if you want to take that more active approach, waiting is usually a better method as opposed to going all or nothing. Let's say betting all on consumer staples because we're in a scary environment. Consumer staples, things like grocery stores, and utilities is another kind of area. Things that will likely continue seeing strong business demand even if things slow down because they're required, if you will. They're consumer staples, as the name says. Rather than going all into an area like that, you can play it actively and tilt a little bit. But it's important to recognize that we always say that we can't predict the future. We should probably act like it, and especially around economic news. I mean, I'm sure you're fully familiar that a lot of the data we get about the economy in the current state we're in is lagging. So by the time we were receiving it, especially gross domestic product is the best example of that, and unemployment figures, I suppose. A lot of that information is lagged where you might already be recovering from it, but you're just now finding out about how low you were a couple months ago. And that can lead to people, acting on news that's already stale and actually is misrepresenting the current situation you're in. So to go back to your question, a lot of other analysts and economists from the banks that we subscribe to anyway, not very, they're weighting it. And when you talk about like higher growth companies, there is more of a pessimistic view. So whether it be more speculative positions that, just started their business in the last few years, or just, generally higher growth companies, a lot of them are factoring in a slowing growth rate over the next few years, which makes sense. If you expect a slowdown, companies that were growing, doubling in volume over the last few years, well, things might slow down as households pull back their spending and there's kind of more pessimism in the economy. But it's really not a all or nothing approach is kind of the main thing of it. So you see the sensationalist headlines kind of promoting that idea that yes, it's either prosperity or destruction. A lot of the time it's somewhere in the middle.
Yeah, okay. So that is already interesting to me because I think like on the academic side, there is a slightly large. I get the feeling from your answer on the academic side. There's actually a slightly larger sentiment towards like proper risk, like big risk, than in the professional stock picker research world.
Yeah, I think that's fair to say. There are certainly, the term bears in the market. People who are very doom and gloom. There's plenty of voices out there, if you will. Some people who will advocate buying gold and things like that to wait for whatever to come. But in truth, on the one hand, we are in unprecedented, situation with quantitative tightening, at least the scale of it, and global supply chain, issues in China. All that is very scary and risky. On the other hand, we have seen stock markets recover and continue to prosper through very stressful periods, including the Great Depression and 2008 financial crisis, obviously because of stimulative measures in the latter. But it's to say that, there's not much of a case for arguing the total collapse of an economy or the stock market. And, even though those two are separate things, obviously there is a connection where if you have the collapse of an economy, it'll probably hit the stock market.
Yeah. So then let's go to and at some point, just to assure everybody, I will also we will also be taking questions from the audience.
Sure.
But before we do, there was a poll I did with the audience stating pretty much like how much macroeconomics or do investors actually need, and then the options were it's for like it's very important for most of them. It's only important for a select few, or people, or it's like a little bit middle of the road.
Sure.
So what would be your opinion on that?
Sorry.
The result was
Right.
mostly positive for that. Hey, you should know macroeconomics, and then quite a few people also voted for it depends on what type of investor you are.
Yeah. So to that point, I would say I agree to that in the sense that if you subscribe, let's say you're a fully technical analysis based investor, I don't necessarily subscribe to that or believe in that approach, but there are schools of investing, you can call them, that pay no attention to that stuff. Not saying all technical is like that, but there are certainly some schools. My own view as a fundamental investor anyway, someone who
And
buys
technical investing is basically looking at the chart, right? And searching for patterns.
Yeah, so very quick summary of technical analysis. Technical analysis is the belief that the price of a stock reflects all the information you need about that company. It's sort of a quasi-efficient market kind of basis in the sense that, well, if a company's trading at this level, it's because that's what the market has deemed it worth. So therefore, the only price data point we need is the price of that stock. The problem with that is that there's not a whole lot of research that supports the notion that technical analysis actually helps you. And a lot of the time, it's just people trying to superimpose patterns onto historical data sets. And, you can see there's a joke that, if you take 10 technical analysts, they'll point out 10 different price patterns for the same stock chart.
Yeah.
So it's kind of I don't want to say there's no merit in it, because there are technical indicators I think are helpful to have an eye on, because they can tell you if the market is aggressively buying a stock or selling a stock, and there are insights provided by that. But it's to say that someone who focuses solely on that, it's really limiting your insight into the companies you buy. And there are certainly approaches that try to a lot of online courses will talk about technical analysis because it's the easiest to convince people, and there's a lot of snake oil in that space, so it's a very tricky landscape to navigate. But regardless, so that's technical analysis.
Yeah, but before
analysis,
we move to fundamental analysis, there's one thing that you said that surprised me a little bit, in the sense that you said like this comes a little bit from an efficient market perspective. But I always figured that technical analysis is sort of anti-efficient market, because if you assume the price is right now, then there's no reason to expect a pattern.
Yeah, and that's why it's kind of quasi for it in the sense that some aspects argue for it, some argue against it. It argues for it in the sense that the technical analyst, in terms of pure technical analyst, doesn't believe that you will get any helpful information from researching the underlying company.
Right. Okay.
That all that information will be reflected. What they instead believe is that the prices of stocks will follow trends, and that it's more so buyer and seller behavior that matters. So that's kind of the distinction there. I think a true subscriber to efficient market hypothesis would believe that trends don't necessarily exist either.
Yeah, there shouldn't be a trend, because that should already be reflected in the price.
Exactly. So that's where they differentiate is kind of the now there is actually, funny enough, I was talking to Ben Felix, who another Canadian finance YouTuber, and he was talking about how there's a famous 5-factor FAMA French model, which is kind of the passive investors, or one of the more passive approaches to analyzing stocks.
Yeah. And they look at what 5 factors again? Do you remember?
You know what? I never know them off the top of my head.
But one or two, like small caps or something like that, right?
Small
firms.
Cap, value in the sense of the company's price to its book value. It's basically 5 factors that try to explain why a company is trading at the price it is. So there is value in kind of understanding those factors. And recently they released a new iteration with the 6th variable, which is momentum, which is kind of funny enough, that trend aspect of if a stock has done well in the past, this kind of bleeding into the future performance. And I think he said something along the lines of the guy who reluctantly added it to the model because it sort of went against the theory behind efficient market
Because that's
analysis.
pure behavioral finance. Momentum is a behavioral finance kind of
and that's where the
factor.
two and I would say, actually, funny enough, even though I believe in behavioral finance and not inherently pure technical analysis, that's another area where the two might differentiate. Is efficient market kind of explains things through risk variables. People who don't believe, or anomalies can arise because of behavioral variables. So it's just, how do you explain what you see in the market? You can explain it from a risk perspective, or you can explain it from a behavioral perspective of, people are doing it because they're risk takers who are willing to take that, and therefore they get rewarded. And then there's behavioral who say, no, this just happens because people are not good at at investing, or become overconfident, or whatever have you.
Yeah.
So yeah, I'm actually seeing the comment now. Someone shared the factors. Thank you for sharing them.
Awesome.
So I think it shows my hand. I don't use the 5-factor model at my job. But I have, it is it's a quite popular model.
It's a finance 101 thing, right? So we're going to get to economics, but if you want to learn finance, definitely learn about the 5-factor model, learn about technical analysis, which is following charts, and then momentum, which means if the stock goes up, it will continue to go up. If it goes down, it will continue to go down.
Yeah, exactly.
Yeah. But you're a fundamental investor.
Yeah.
And what's that?
So fundamental investing, people love to point out Warren Buffett as like the face of that movement. But it's kind of just investing with the thought of, at the end of the day, you're just buying a business. So the analogy I like to put is if you were to buy a convenience store or gas station, what would you, as an everyday person, look to understand before you made that decision? You probably wouldn't care. Maybe you would, but you wouldn't put as much merit into what it traded for in the past. You'd probably care a lot more about, how much money do they make? Who are their suppliers? Which does their employee base cost? That's fundamental analysis, is just trying to understand a business and seeing whether you want to own it as a investor. So it's, on the one hand, it's a lot more qualitative than a lot of other like quantitative investing, which is sort of a third school of thought, and actually what Patrick Boyle would himself describe himself as, focuses on backing out relationships using data analysis of quantitative variables. So basically kind of just doing a bunch of regressions, if you will, and seeing where are the correlations, and can we use this to exploit and make a profit from trading.
Yeah. And these are fundamental variables then, or it doesn't matter?
I don't think it matters. True quantitative analysis probably will look at anything, including even technical variables. Really, it just focuses on taking quantitative factors that you can analyze and regress, and seeing what relationships exist and what's statistically significant, and whether that can be used on a forward-looking basis to trade or invest. And I think there's a lot of interesting work that's done there. And actually, with a conversation with Patrick himself, one thing he pointed out is that in doing that, you see that there's never a consistent relationship that investors can exploit. Yeah. So it's not like you do a quantitative analysis and find the golden formula that sets you for life, that you just find this one piece, then you can go sit on a beachfront and have this robot trade for you. It's constantly changing. The markets are constantly changing. The relationships between these variables, because partly to your point, macroeconomic factors greatly change the situation and how different variables might interact with one another. Yeah. A low interest rate environment versus a high interest rate environment might actually change how different variables react, and what investors reward or what investors punish, if you will, from public stocks.
Yeah. So, and if you're a quantitative investor, right, then you're running an algorithm typically, or you might also do that. And it might, like, you might be in 2007 and you've backtested 10 years, and the best thing to do is actually invest in houses. But then it crashes completely. Well, then maybe you could have seen momentum. But when then the central bank intervenes, your backtested algorithm could never have spotted that, no matter how good your data was, because that never happened before.
Yeah, and that's kind of a point to keep in mind, is especially on the long term, and I think a lot of quantitative investors would agree to this, is that similar to not finding a golden formula, you probably won't find something that shows you a long-term relationship that you can rely on. Because a lot of outside the fact that there's just more data to support shorter-term relationships, if you will, it's just, I think, people aren't blind to the shortcomings of their own approach. Just like as a fundamental investor, I'm well aware of the shortcomings of that school of thought. But for quantitative investors, I think a lot of the time it's more short-term focused as opposed to, say, buying and holding positions for 5 years. I'm not a quantitative investor myself, strictly speaking.
Yeah.
I would assume that's unlikely to see buy and hold strategies in that realm.
Yeah, but you are a qualitative fundamental investor, and so you look at the fundamentals of company, look at their price, and see if the two match up, roughly speaking.
Yeah, so I say there is, a quantitative aspect to it. You do obviously look at their finances, but it's more so qualitative in the sense of, really understanding the variables that impact the business and whether you think those variables will continue, whether you think they'll improve or deteriorate. So there are judgment calls that come with fundamental analysis. But I think at the end of the day, what draws me to that function is it just makes a lot of intuitive or logical sense because it's more tangible than the other two, I would say, in the sense that, again, if you look at investing, which is what it is of buying a business, technical analysis looks at buying stocks as price tickers. Quantitative analysis kind of looks at it as a bunch of variables that will determine whether you make money or not. Fundamental analysis looks at buying an underlying business and whether you think it will do well over time or not. So there are qualitative features to it, certainly subjective calls, kind of similar. I can't be all that rude towards technical analysis because you could probably get 10 fundamental analysts in a room and they'd probably say roughly 10 different things about the same company because a lot of it is subjective. But one approach that I've kind of learned from my company is to focus. It's really focusing on companies that you like the return potential, but also capping the amount of risk you're willing to take. And that risk can be on the side of debt, as opposed to buying a bankrupt company or a company that's very close to bankruptcy. And it's not to say that there's certainly approaches that would actually focus on bankruptcies and stuff because there is a large return potential, but that's where you get to more lottery-like positions where, it's kind of a
distressed debt markets and all of that stuff.
Yeah, heads it makes you a big return, tails you lose everything. So we try to avoid those situations. Yeah, we do a bit of diversification, nothing too crazy. But as opposed to just buying 5 or 10 positions, which is kind of what Warren Buffett and Manish Pabrai and a lot of famous investors advocate for, we might hold a bit more than that. But it's really just, that core belief of investing businesses that you like, that you think the finances look good, and importantly, that the valuation makes sense because how much you pay for a stock is just as important as whether the stock is actually a good company. Yeah. Because if you have an exceptional business, but you pay an above exceptional price, you could actually still lose money on that same position.
So and this is one of the key things about investing, right? That people don't appreciate enough, perhaps. Because it's rather simple, right? If you say it like that, everybody's like, yeah, sure. But for example, what I noticed once myself as an economist, that we had invited an investor in one of the macro classes, international finance, that we taught. And he said, like, we use some of your models. So we used, what was again, the impossible trinity, which is a concept in macroeconomics that you cannot have central bank independence, a fixed exchange rate, and free capital flows. That's a concept. And you can use that model to look at a country. And for example, if you use that model on Sri Lanka, you could have seen like, hey, something's got to give here. They had a fixed exchange rate. They wanted monetary independence, but and they had capital, free capital, and that can truly break an economy. But what he then told me as well is that most of the students in that economics class, and I'll admit myself included, for a brief moment of weakness, we're thinking like, hey, oh yeah, what are weak countries, right? And we're not going to invest in that. But that's wrong, right? It's like, hey, what are weak countries that are cheap and we're going to invest in them? Or what are strong countries but are overpriced, right? Or what are weak countries and are expensive and short them? But yeah.
And that's the thing is to the point about investing in bankrupt companies, you can make a killing in that space. And it's not to say that I don't think it's an invalid approach to investing. And, Warren Buffett his first approach to investing was what he called the cigar butt approach, which was the idea of getting one last puff out of whatever he bought in And there were times where he would make money even if the company went bankrupt, because, for example, the assets of the company, so, their factories, their real estate, whatever they had, was actually worth more than what the stock was trading for. So even if the company goes bust, if they liquidate everything and push that money back to the investors, you could still make a return.
Yeah.
So that's something to keep in mind. Is certainly, what a lot of people have seen over time is that markets tend to and this is a broad statement, so there are obviously exceptions, but generally speaking, markets tend to overvalue excellent positions and tend to undervalue distressed positions. So if you can find those positions that are distressed but have potential to, at the bare minimum, even just stay afloat, but are valued even less than that, then you could still make a profit if that normalizes back up to even a distressed level. So that's the thing, is even within fundamental analysis, there are totally a wide array of different approaches to investing. Some people who are a lot more willing to take riskier approaches when it comes to debt restructurings and whatever have you. For us, though, a lot of the time we're managing money for households that aren't looking to make hundreds of % of return, and really are focused on risk. Like, you'd be surprised how many millionaires just don't want capital to be depleted. Like they just want their money to grow a little bit without much risk.
Yeah.
Which is actually opposite to what you would expect, because you would think, well, you have, the more money you have, the more risk you're willing to take on. A lot of the time, the clients we deal with, if they're an everyday Joe who either worked up the corporate ladder and got a good position and makes a lot of money, whether they be a business owner, a lot of the times they just want to set their finances and forget it, and they don't want to check their statement and see that they're down 50%, even if it means that they'll be up 100% next year, whatever have you. A lot of people focus on risk, which, funny enough, can be a detriment. But all to say that it's
and then they come to you, the riskless plain bagel.
Yeah, well, I wouldn't say I'm riskless. I would just say that when it comes to things, there are certain types of risk that I'm not willing to take. There are risks that we take. You wouldn't make any money if you didn't take any risk. So there are risks that you have to take. The thing, though, is to balance that risk with your tolerance, and to keep in mind the risk of a position relative to every other position you own in your portfolio. So, if, for
correlation,
example,
you mean?
Yeah, correlation. Yeah, so, if you think of diversification, trying to find positions that are uncorrelated, you don't want everything to fall at the same time because of the same risk factor. So one that, we saw over the last few years, a lot of people jumped into tech stocks, high growth companies. And then now that interest rates are rising, all those positions are very highly, the whole market is down.
Yeah.
But the ones that have fallen the most are those high growth tech focused positions. So it's just kind of from a risk perspective, you really shouldn't put all your eggs in one basket, even when it comes to sector diversification.
Yeah.
So you can take risk, but
don't be ARK Invest, is what you're saying.
Yeah, I mean that's an example. I wasn't gonna name drop, but yeah.
I can, as an academic, I can just say stuff that pisses people off more than you.
Yeah, I mean, like I think I can talk out against money managers, but it's ARK Invest is an interesting one, because I remember Tesla's a bad example, because they're actually up, if you look over the past few years. Yes, they're down currently from their all-time high, but they've done well over the last few years. But I remember reading ARK's research report on Tesla, and this was before the recent share split. So right now, pre-share split, they're between $600 and $700. And I remember their bear case for Tesla was $1,300. And I was like, no, that's not what bear case means. Bear case is bad. You can't say our worst case scenario is Tesla doubling.
But my worst case scenario for Bitcoin is $100,000, Richard.
Well, hey, that sounds like a great investment thesis. But like, that's the thing is, their approach, I think they didn't hire many financial analysts. I think they were trying to take the approach of, hey, well, and if you bring engineers and if you bring tech specialists and you put them into an investment team, you might outperform the market. And I think the Renaissance Fund is a famous hedge fund that consistently outperformed the markets for a number of years. And I think that was actually their approach, is they hired PhDs in academics as opposed to your Wall Street analysts. And I have a feeling that not Tesla. I feel that ARK might have been trying to replicate that. Hey, if we hire outside people to think differently, and there's validity to that.
Yeah.
But then I think their models might have been a little flimsy because of that. I think they might have just wanted to have at least one stock guy to be like, hey, this model doesn't make sense.
Yeah, or let them watch the Plain Bagel to at least get the basics, right?
At least, yeah. I mean, yeah. Maybe it would have helped. I don't know.
Hey, so I have a small question about sort of markets, fundamental investing, technical investing. But before that, I think we should open the floor to the audience before we also we still need to talk about all the macroeconomic stuff. But I think it's been very insightful, at least for me, to learn a little bit about how you actually operate as an investor. So if there are any questions, what I'll do, Richard, I'll just go through the questions and I'll look for some, or can you see them as well?
I do have them up, so I can definitely.
Well, you can. Let me know. What do you prefer? Do you want me to pick one, or?
I'll say you go ahead and pick some, because I also don't know what you'll talk about in the later on.
So but that doesn't matter. That doesn't matter. So I'll just pick one, and then you can pick one.
Sure.
Because I think for you it's a little bit of a novelty that people can directly talk to you, right? You don't.
I'm behind my gilded. I'm in my castle most of the time.
Yeah, the untouchable Richard. Okay, so I do have an easy question here already, which I think is indeed interesting, because you were talking. I think I'm just doing the context myself, but because you were, I think this question is asked because you were talking about credentials. Richard, what are your credentials? It's asked by Brainstorm 5556.
I would say you should always be asking that question, especially if someone's ever given you a stock pick. I think that's an important one. Is what are their credentials? So my credentials are kind of the two important ones, I guess, would be Chartered Financial Analyst designation. So CFA, it's kind of it's really the only. I don't want to call it gold standard because it's kind of tooting my own horn, but it's one of the only kind of broad-based accreditations out there in the world of finance that's globally recognized. There are a few others, but that's kind of the broadest one, if you will. I also have my Certified Financial Planner designation, which is a bit more generalist. Touches on things like insurance, taxes, and things like that. So even though I focus on investing, I did take that because when you have an investment client, they sometimes bring up questions about insurance and stuff. So that's more of a generalist one. But outside that, bachelor's in finance, and not an education credential, but as I mentioned, fully. I see questions. Yes, the CFA is what I'm saying.
Yeah, and experience, right, as an analyst.
Yeah. So I've been working in finance in the industry. I graduated in 2015, I believe. So since then, I've been working in the industry as an analyst for 7 or 8 years. And more recently, fully registered over the past 2 years as a portfolio manager, which in Canada anyway, I'm not fully sure how the registration works in different countries, but in Canada, it's one of the highest levels of registration you can get on the advisor side is to be a fully registered portfolio manager. It basically just means that if I took on a client, I could buy them any type of position on a discretionary basis, meaning that you could just put money into an account and I can do all the work for you. There are different levels where you have to call the person and they have to confirm every time you buy. So those are and it's different in the US. I think, again, not to toot my own horn, I think it is easier in the US. I think after the Series 7, a lot of people can get to that same position. So those are my.
Oh, that's interesting. So when I finally have some money that I have to invest rather than in my own YouTube channel or my house, I should look for a Canadian advisor, not a US based one.
I don't want to crap talk the US system.
Well, you just did a little bit.
Yeah, that's my perception of it. I don't know a whole lot about the process. I just know that it was a pain to get my registration. And mind you, there are different routes. I believe in Canada even you can take the CFA. I believe there is another route through maybe the CIM designation, which I believe is a Canadian one. But all to say that Yeah, I don't know. I think with anyone, it's about, there's more to it than just the credentials. I think it is important to find someone that, aligns with your values. If you find someone who's out there buying tech stocks and stuff, they might be fully accredited and everything, but if they're doing a different investment approach and you just, want to sit on your investments and earn a reasonable return, that's important to consider as well in terms of, and experience and stuff. So there's a lot to consider when choosing a financial analyst. I think Canada is a bonus, but I think Canada actually has a pretty well regarded finance sector. Even though we're closely tied to the US with 2008, Canada did really well throughout that whole debacle because our banks anyway had more strict lending practices than the US did. It still hurt, but you didn't see property values collapse like they did in the US.
Not yet.
Not yet. Hey, you know what? I have some friends looking to buy a house who wouldn't be too upset if that was the case.
Yeah, but it takes typically a crash takes a couple of years though.
And the tricky thing with with real estate too, it's easy to oversimplify it and say, yes, interest rates are rising, therefore housing prices will go down. There is still a fundamental supply and demand side to it, right? And Canada has very strong immigration, has very limited supply in cities like Toronto and even here in Ottawa. At the end of the day, interest rates will have a downward pressure onto demand. It itself might not be what crashes that market if there's still that underlying, if people are still coming to Canada in troves, people still need housing.
Yeah. That's definitely something that's quite unique about Canada is the amount of immigration that they let happen, right? Talk about macroeconomics. That's one factor then, right? Immediately, like population dynamics, a very well-known macroeconomic factor. Extremely important in the property market and also fairly important in many other markets, I would guess.
Yeah, and I think, I don't know if I actually answered your question about the importance of macroeconomics with investing, but I would say...
No, I haven't asked it yet. We were basically going off a tangent after talking about your credentials.
Well, so to answer it quickly anyway, I would say based on my own approach, again, as a fundamental investor, you can put different weights on macro. For sure, I would think it's silly for anyone to not have a basic understanding of macro because you can see firsthand how drastically the stock performance changes under different situations. Bitcoin, tech stocks, high growth companies, all did exceptionally well when stimulus measures were there, and all have since done exceptionally poorly as those stimulus measures are taken away. Now, it's not to oversimplify it. There are other variables to consider.
Yep.
But clearly, there's some correlation there that makes intuitive sense. So, for someone to invest and not have any comprehension of what quantitative tightening is or how rising rates impact the stock market, you're really handicapping yourself in terms of researching stocks, right? People take different approaches. Again, even within fundamental, you can do... There's like top down and bottom up. So top down research is when you say, okay, let's look at all the macroeconomic factors. So, you mentioned Sri Lanka, the US, Canada. So you look at all these countries and you say, okay, well, Sri Lanka's in a troubled spot. Canada, they have their hockey teams haven't won the NHL Stanley Cup in a while, so whatever. And let's focus on the US. Then from there, they might say, okay, what sectors do well within the US? And it's kind of this top-down approach where you go based on geography, then sector. And then once you decide which industries you want to invest in, then you pick stocks that you like. So that's a very macro-focused approach because you say, well, based on inflation...
You start with macro and work your way down to the stocks that you like.
Yeah. Bottom up does the opposite approach where first they consider the fundamentals of the company and say, well, I like... I just say Google because it's one of the easiest to think of, and because we're both YouTubers, so it's not a recommendation, but just one that comes to mind.
Yeah.
Let's say I like Google. I like how much money they make, blah, blah, blah. Then I might consider the macroeconomic factors after the fact, and that might tilt my positions, but I've already decided what my focus of stocks will be.
Yeah. So you selected a basket, and then you can look at the macro stuff and maybe remove a couple from the basket.
Yeah, exactly. And you like macro matters for individual companies as well. And the funny enough, you can get kind of a macro view even just from bottom-up analysis, because a lot of the time, company management will tell you about how the macroeconomic environment is impacting their business. They'll talk about foreign exchange, how that's impacting their profitability. They'll talk about inflation rates. That's a big one. You'll see it all over transcripts of, well, how is it? And a lot of earnings calls, they'll open the kind of like this. They'll open the mic to viewers and ask for questions for management. And a lot of the questions are, how is inflation impacting you? Are you seeing your costs rise? Are you passing those costs off to investors? So it's, even if you take a bottom-up approach, you get you see a lot of macroeconomics in the investment analysis process because it's important. Like that's as simple as it is. It's there are a lot of factors to consider as well. I wouldn't want to oversimplify something and say when interest rates rise, sell stocks or whatever, because I think that's way too oversimplified and not, historically speaking, correct in all contexts. But for sure, there's an influence there. You can consider it as one downwards arrow amongst a crowd of up and down arrows. Exactly. Yeah.
Yeah. So when I'm listening, because I had one question in mind. It's like let's say there are some investors watching, but they had a background in engineering or maybe in pure finance or business or whatever, and they don't know too much about macroeconomics. What would you think, like, what's the stuff, like, what should you, besides, of course, watching One Year Macro, look for, right? What are the topics? So I heard you talk about exchange rates. That's probably mostly important for people like you who are living in a country with its own currency that's relatively small compared to the US. Or if you invest in any of those countries. But also I heard you mention inflation is super important. How central banks work, basically, right? Because they have such a massive impact on the market
of course, yeah.
these days. Maybe sort of the basics of business cycles and GDP. Am I missing?
I mean, at a high level, that makes sense, right? Like obviously you should have some understanding of economies, recessions, things like that, and to all the points you mentioned, central bank action is important. I would say interest rates are kind of the core one there. Quantitative easing and tightening is sort of an extension of that. So I think those are important ones to understand, especially in the current environment. Those are really hot topics. Inflation is one, but even just kind of more basic factors to consider as well. Things like unemployment, things like household debt is one to consider.
Yeah.
Because at the end of the day, if you have a business that relies on consumers, well, you should see how healthy the consumer is, the average consumer is. And interestingly, we're kind of in this space where currently a lot of economists are saying the consumer is very healthy, but also their debt's really high. It's kind of this 2 and 2. A lot of economists that I've read anyway from our providers are saying that household budgets have a bit of a cushion, I guess. So pandemic savings from not traveling, from saving on commutes, and stimulus measures, those have offered a bit of a buffer to help with the rising costs of debt and things like that. But we also have a historically high debt load for households, for even companies, and of course the government. So debt's kind of it's an interesting one because it's such a fundamental component to every economy, virtually every economy around the world. So I think having some eye to the health of the consumer and debt levels in general is important as well. But you really, you did touch on it, like exchange rates. And I would actually argue, even though Canada, very important here because even though, as with a lot of countries, there is a country bias with investors, we probably invest more in Canadian stocks than any other country because there are incentives and things like that. And it's sort of this familiarity, right? If you live in a city, you might understand more about the business culture and stuff. But we invest heavily in the US as well. It's easily, and as with a lot of countries, the second largest portfolio allocation will be to the US. So obviously exchange rates really matters there. And, Canada's basically moved from being at par with the US to being around kind of the 75-cent range, now a bit less actually.
Since when? Since after the pandemic, or?
Since after the pandemic, it's varied, but the US dollar currently is doing very well during the pandemic, and currently they're definitely not at par. The Canadian dollar is worth less than the US dollar on a dollar for dollar basis. Last I checked, it was $1.30 Canadian for US dollar. So, but interestingly, during parts of the pandemic, the Canadian dollar did well because we're an oil-based economy, or at least oil is a very heavy component. Real estate and finance are as well, but oil is a very big part of our economy. Yeah. So, when we had oil prices surging past 120, the Canadian dollar did quite well, because obviously oil is a big export of ours, and if oil prices are higher, the Canadian economy might make more money. It's since moderated and oil prices have come down. They're now currently under $100 a barrel. I think they're around $90 a barrel on the West Texas Intermediate. But all to say that exchange rates matter a lot for Canada. I think they matter for other investors too. And like I mentioned, there's I would say the majority of at least, say, S&P 500 positions, US-based positions that have international operations. So it still matters for even, again, a bottom-up investor is, companies like Google, companies like Microsoft, these big companies, they have a lot of international presence. And a lot of the time, they'll say, we did well this quarter, but FX, foreign exchange, was had a negative 2% impact on our earnings. Like that's how they'll speak about their earnings. So it still matters for even kind of the more domestic investors who might not care much about. At the end of the day, we're a very globalized economy these days, so it's kind of hard to avoid that impact. It's still important to understand, I would think.
Yeah, it reminds me actually of when I used to live briefly in South Africa. I was looking into, hey, maybe I can now invest in the Johannesburg Stock Exchange. And then I was looking into it a little bit because I was thinking at the time we had this in South Africa new president coming in, Cyril Ramaphosa. It looked hopeful, especially compared to the disaster of a president that came before. And so I figured, you know what, I might be getting a little bit bullish on the South African economy, and importantly, sticking to your investor fundamentals, I think the South African economy might be underpriced, right? But then I was looking into this, and this is another thing that now we're talking about what I got from investing, but classes or finance. I was thinking, hey, maybe I should look at the correlation of the Joburg Stock Exchange with the South African economy. And then I found out, like, if you buy just the index of South Africa, right? That's the Johannesburg Stock Exchange. You're not buying the South African economy. What you're buying is a long position in commodities, because it's just so heavily, you have these massive mining companies. The stock exchange is just so massively exposed to the global economy that does that story make sense to you as an investor?
Yeah, and like, kind of talking about Canada, I think you would very likely see a similar correlation with oil, right? When oil's doing well, we get our trade deficit improves. You would just see those variables impact how the country as a whole is performing, because oil and real estate and finances are so important to the economy. So you might, and funny enough, Canada has a very small tech and healthcare sector. So, you can invest in tech and healthcare in Canada, but the broad index is very heavily weighted towards energy, finances, and real estate would be kind of some of the biggest ones. So yeah, and at the end of the day too, I've kind of touched on my channel. There's also some separation between the economy and the stock market as well. Like, the stock market is still just a subset of the broader economy. So even within a biased economy, if you like, towards sectors, if you will, you can have even more bias at the stock market level, because in Canada, for example, we don't have many or a very large healthcare public market system, because we have public healthcare. It's not as profitable of an industry. But there might be private companies that aren't listed on the public stock exchange, that aren't reflected in that. So I'll just say that, yeah, it's hard to and that's the tricky thing about investing, is there's rarely a situation where one factor makes something a good investment case. something like, well, I think this country is going to do well. That might not be enough to justify buying a company. It's always worth considering all the fundamentals of the underlying businesses as well. And to your point, all the different economic variables.
Yeah. And hey, do you maybe have talking about this? Do you maybe have some concrete examples for us? And I know that you're bound by you being an investor, but maybe you can say because I'm especially interested in when you have made an investment, but you have been surprised, and it would be even like gold if that was through macroeconomic factors. But other ones are also interesting. Like you were taken off guard, right? So something happened that you didn't expect, and you learned a valuable lesson from that. Do you have something like that?
Yeah, I have a few. I'm not sure. This wouldn't necessarily. Yeah, I have a few. I could talk about like one, for example, at a macroeconomic factor level, for example, is oil and gas is an easy one. Obviously, it's a very important industry here in Canada. In 2015 or so, or shortly thereafter, 2015, from 2017 to 2018 was the peak of it. There's a bit of an oil glut in the U.S. that heavily impacted the Canadian market. Basically, U.S. companies discovered, hey, we can efficiently and economically extract shale oil. Mm-hmm. So basically, if you think of it, there's a big rock. There's all these tiny droplets of oil spread throughout the rock. Through engineering, methods and what's fracking and things like that, they discovered that, hey, we can actually draw that oil out very effectively. And all of a sudden, you had shale oil companies popping up left, right, and center within the U.S. and greatly increasing production. That had a huge negative impact on Canadian markets because all of a sudden there's this oversupply, and the U.S. is Canada's primary buyer of oil. So if the U.S. has enough oil itself, they're not going to buy as much Canadian oil. Probably, and that was actually early at my current company, early in my position as an investment analyst, that was happening. I was very much assuming that, general supply and demand factors, oil companies will rebound very quickly, blah, 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 because you have an oversupply, that'll make companies unprofitable. So, hey, if we focus on companies that have manageable debt, can manage through this, they'll be okay. 7 years later, it's still a pretty pain-stricken area. Companies have done very well over the last couple of years in oil and gas, but from back to 2017 or 18, they're most likely still down. And part of that is the pandemic, which impacts oil demand. But even though the price of oil is now higher than it was back in 2018, stock prices are still a third of what they were back then. So it goes to show that's, like I said, I've kind of learned it's not as simple as just, well, if oil prices go up, then companies will do well. There's a bit more to it. And I mean, like, I'm not afraid to share my failures as well. There's a lot of times I've learned that even fundamental analysis isn't necessarily enough to, prove that you'll do well with the position. One example, there's this one company, I forget the name of the company, but it was a smart web security camera company. Mm-hmm. So they basically sold security cameras that used AI to monitor, shopping centers and stuff, to point out, hey, like this car is acting suspiciously or whatever have you. And I remember saying that we should definitely not buy this company because every year they changed their definition of profit. So to me, that was a massive red flag of, well, that's a lot of risk. The integrity of management is a pretty important factor. Again, that goes back to kind of the Warren Buffett school of thought of, if you don't know a lot about a company, at the very least, if you know that's run by honest and hardworking people, that you'll probably be in good hands. So to me, anything that shows me that management doesn't respect the investor or doesn't care about the investor, it's usually a red flag that will make me not want to buy it. And yet, a year after I made this recommendation, even though I had what I would call the smoke around this position, ended up being acquired, and I think it jumped in value by like 50% because another company purchased it. So it went to show that you can actually have a very strong thesis against or for, and we didn't short the position. I don't short positions, but we didn't buy this position itself. But it still made money for those who bought it. So that's the tricky thing about stocks is I think I spoke to one of the partners at my company afterwards, And he said something along the lines of like, Richard, you might see smoke. It doesn't mean you'll find a smoking gun. So it's not to say that you should ignore suspicious activity. It's just to say that the market is a fickle thing. It's really tricky to do well, even if you have very sound research. There's nothing that I could have done to predict that another company was going to purchase it.
Yeah.
But it's a known unknown, I guess, is the way to think of it. There are risks you can know and that you can measure. There are risks that you have no idea might even happen. Black swans, things like that.
Yeah, yeah, and this. Okay, so I have a question about this, but I do remember that I don't think you have actually looked at a question yet. So maybe we can in between see if someone else also has a question about all of Richard's investment failures, which there are very few, of course.
Yeah, I see one question here from Supernova. Doesn't Canada have something similar to GAAP reporting? So the GAAP being the accounting rule set that the US uses. Canada uses IFRS, so International Financial Reporting Standards. Funny enough, I actually read this book a long time ago called Easy Pre-Investing that talked about why Canada's IFRS system was very lacking. And really it just argued that the US has the best accounting system and Canada's gives a lot of benefit of doubt to management, meaning that management gets a lot of discretion in terms of how they classify different items, which can very greatly impact their earnings, which is important to consider as well as, kind of same thing with investing. It's what makes it complicated is sometimes you have to be skeptical of even the numbers that they give you to say, well, could they have fudged these numbers somehow? Could they have done something that might have altered this a bit? And it's why, having an understanding of all accounting statements, not just the income statement, is important, because a lot of the time an income statement, the shortcomings of the income statement, you might be able to pick up in the balance sheet or the cash flow statement. It's why it's good to have a fully rounded view of things. But that book, Easy Pre-Investing, I can't remember the author, but it's by these people who are, forget the term, but basically investigative accountants. So they basically investigate forensic accountants. That's the term. So they investigate fraud through accounting statements. So it's a really interesting book, and they like their full-time job is auditing and finding shortcomings and things like that. But the nice thing about the book is they kind of highlighted some practical things for identifying, not necessarily identifying, but things to look for basically when it comes to researching companies and making sure that they aren't pulling a quick one on you, because there are companies out there, I don't go into investing assuming that every company is trying to screw me over, but they certainly exist. There are certainly companies out there that are just trying to take investors' money.
And there's super famous cases, right? Like Wirecard in Germany and Enron in the United States. Like all of these companies, I would guess, if you're as a fundamental investor, but you don't understand accounting or you don't dig a little deeper and just look at the accounting fundamentals, they look super healthy, no?
Yeah, well, that's exactly it. Is if you take things at face value, they would look very healthy. But then there are checks you can do. You can check their cash flow statement and not just look at the total amounts, but if you go line item by line item, you can dig a bit deeper to understand, okay, why are the figures looking the way they do? And one thing I see a lot, actually, especially with a lot of growth companies, a lot of people don't know how to deal with share-based compensation and things like that, which is basically a company paying employees with its own stock. A lot of people kind of ignore that when analyzing a company, even though that's a huge thing to consider, because when times are like these, when stock prices depress, all of a sudden those employees might be demanding cash payments as opposed to stock options and things like that. Not to mention there's dilution and things. But all to say that if you don't fully understand how to consider share-based compensation, you might look at a cash flow statement and say, hey, this company is doing really well. They're making all this cash. The only reason they're making that cash the way they are, though, might be because they're not paying their employees cash. They're paying them stock options, and it's still something to consider. So there's a lot. I always say that accounting, if I can give casual investors who want to research a stock a tip, I would say take some sort of formal accounting training. It really is important. There's a lot of stuff you can learn at a base level on YouTube. I think there's a lot to be said for taking some sort of formal course that forces you to do examples, to practice, because accounting is there's a reason that an accountant is a full-time position. It's its own language, really, and the language of understanding stocks, really.
Is that even more important than taking a macroeconomics class then, Richard?
Well, I don't want to insult you. I would say you need to know about both. I would say accounting, I think, requires more of that formal side of it, because like I said, it's kind of like learning math, right? To learn math, you have to do examples. We've all taken math classes where you have to do equations and things like that. That's really the best way you learn math. Accounting is very similar to that. So that's my opinion. Is I think you would certainly benefit from taking a formal macroeconomics course, and I think that would probably do you better in terms of working through sensationalist stuff, because economics, as I'm sure you're aware, is very prone to those types of headlines on YouTube and even articles sometimes, from respected journalists can still be a bit more sensationalist. So there's certainly value there. But all to say that, I think accounting is where I see a lot of people lacking with research anyway. It's not to say it's all that matters. I don't think it is, but it's important.
Yeah, and actually, I think accounting is also super important for economists because some of the most tricky subjects that I talk about on the channel, and also some of the most tricky subjects where I see investors, go horribly wrong in their economic assessments, are just because they don't understand accounting principles, such as, for example, how private banks create money. That's a very tricky and weird subject to think about. It's very counterintuitive. But if you write it down in balance sheets in accounting, then it makes total sense. And I think it's the same for money printing, or if you want to understand how a central bank actually operates and how it influences the market, then looking at their balance sheet will help you a lot. That will really help you understand economics a lot more. And I'm actually from a school of thought, or not an official one, but that has been stressing that economists should also learn accounting.
That's a good point. And to your point, money creation, it's a ledger entry, right? That's which itself is an accounting term and an accounting concept. So yeah, that's a good point. I hadn't considered that, but it makes a lot of sense.
Yeah, so I actually did a lot of accounting in my early videos. So if you scroll back to my early videos, and you can deal with the horrible quality of the camera and microphone.
we all have that. We all have that.
Then you'll still find those balance sheets. I stopped it because I think we also discussed this briefly between us, that the sort of lecturing approach works less well on YouTube. People want to be entertained. They want to be able to watch it on their phone or not take notes all the time. But if you want to go a bit deeper, I think that's super important.
Yeah, and I think some people do a good job with it, but yeah, it would be tough to do a successful YouTube channel if all you did, for example, was accounting videos. It's not to say you can't do it, but it would be tough.
Yeah. Hey, and getting back a little bit to sort of the economics and investing, what I wanted to ask you as a fundamental investor, which is what you are, right?
Yes.
So one of the I've basically modeled you in the sense that back in the days, as economists, behavioral finance, in the behavioral finance space, we tend to model what we call chartists, which are basically people who look at charts, and they're basically technical analysts, and mostly we assume that they use momentum. So they think if a stock goes up, it will continue to go up, and if a stock goes down, it will continue to go down. These are one types of investors that we model. Then we have the Richard of this world. We have fundamentalists, but not just you. We give you superpowers. We give you the power to actually know the actual fundamental value, that is the discounted present value of all future cash flows of that company, and we simulate you with these chartists. But what we then notice is that, if we give them a little bit of evolution, so if a fundamentalist does well, there will be more of them. And if chartism does well, there will be more of them because they make bigger profits, which is how markets work, right? Yeah. Fundamentalists, even though they know the truth, they know everything, they have perfect knowledge, they lose out to quite a few of these chartists because they see like, oh, hey, fundamental value is this. But then a lot of chartists enter, and you could compare that to retail traders entering the GameStop saga.
Sure.
And then the price will just go up, and the fundamentalists, they know that's not correct, so they will start shorting. But of course, they will get annihilated. So I was wondering what you think about that way of looking at markets as a fundamentalist trader.
And I think there's some truth to that, where I genuinely, my own view is that GameStop and all that shows a lot of the why it's so complicated to do purely fundamental analysis. Because if especially in the short term, I would say market efficiency doesn't exist within a 12-month period. is kind of my own. There's some degree of it. If a company posts good news, it will generally go up. But there's so much influence in the short term. And really, when you understand how a lot of brokers and investment banks trade positions, you can see that a lot of the volume of share trades doesn't have a whole lot to do with fundamental factors. So, there might be a large institution that's trading based on technicals or whatever have you, or quantitative variables. And if they buy for reasons that have nothing to do with fundamentals, then all of a sudden the fundamentals aren't predicting where the stock price will go.
Yeah.
I think where I reconcile that is looking more longer term, because the fortunate thing about stocks is that for many companies, not all companies, but for many companies, the stock price doesn't mean a whole lot to their operational performance. It's not always the case. There are plenty of companies that continually issue shares, but there are some companies, more value positions, that actually benefit from a lower stock price. And in fact, not to recommend oil and gas companies, but one thing, for example, that you're seeing in that space where stocks are so cheap, if you just look at a simple ratio, you could say that oil and gas is cheaper to other industries. What a lot of these companies are doing is buying back their stock. And that's actually a very easy method of returning capital to investors is, hey, if the public market doesn't want to give you a fair price for your stock, then buy back your whole company. It's an easy use of your capital. And it's, if you truly believe that your fundamental worth is higher than what the public market is granting you, then you can get a very good deal for the shares you have outstanding. So fortunately, for companies that aren't issuing shares, there's not a whole lot of pain that comes from having a low stock price, and their operations likely won't be impacted materially. Now, there is sort of this kind of counterintuitive side of it, where a company like GameStop, for example, might be in business today solely because its stock price skyrocketed, because GameStop issued more shares and took advantage of that and basically raised capital at the expense of investors, because all of a sudden, their stock price is worth a heck of a lot more.
Yeah.
Well, they can get a lot more for their stock if they sell stocks directly to public investors. So it's not to say it doesn't matter, but if you believe in your company and you're in it for the long term, then the volatility of a company stock fortunately doesn't impact the underlying business very much. Which means that, again, if you truly believe in the position over a 10-year period or longer, then you should be able to find, even if the stock price doesn't move a whole lot, the company can pay dividends, which is just passing along the underlying profit to investors. It can buy back stocks, which leads to a similar effect to dividends, because even though it might not seem like it, it is returning capital to investors and giving the remaining investors more of the company, if you will. So it's sort of similar to a stock dividend. It's not perfectly the same, but so that's where I would reconcile it. Is in the short term, I would agree.
Yeah.
I think short-term trading based on fundamentals is kind of a loser's game in my opinion, because there's just so many variables that are not fundamental or efficient. So you could have a giant hedge fund. It was a family office, actually, Archegos, I believe, or it was one of the big family offices that went bankrupt and brought a bunch of stocks down with it. That has nothing to do with fundamentals, and yet it dragged down the stock market because a hedge fund failed. Sorry, family office, not a hedge fund technically. But
although it does have a little bit to do with fundamentals, though, right? Because the how the market operates is also part of the fundamental value of that company, perhaps. But maybe I'm taking it too far. But it's at least it's not technical analysis.
It's not technical, and you have a good point in that there is a fundamental aspect to it, in the sense that you could argue that, say, capital markets are now more difficult because this company has gone under or whatever have you. There is some fundamental impact there. I would say that likely that selling activity depressed stock prices by much more than that fundamental impact on those businesses. Even though this family office is selling these shares, the impact to the underlying business was probably pretty muted in the grand scheme of things. Again, if you take a company that's not raising capital, they're not really impacted by the state of capital markets, at least in the short term. If they're not, obviously they have long-term loans and things like that.
Yeah.
But yeah, so that's where I reconcile.
Okay.
Kind of the time frame.
Hey, and if I may ask you just one more question about yourself as an investor, what are your sectors? Like, what do you specialize in, or does it not work like that?
Yeah. Again, it's not to give a recommendation, but I touched on it. Oil and gas is one area that I've looked at. I am a bit of a generalist because I work for a small company. You wear a lot of hats and I've pretty much looked at every industry at least once. But real estate, oil and gas are two big ones I've looked at. Finances. So really, it is very broad based. But yeah.
Okay, but it's not retail. It's not ICT. There's a lot of other sectors, right? I think oil is. I recommended very specific.
I think I've recommended companies in every sector, even mining actually. Whether it be a buy or sell, I recommended in every sector at least once. So I'm very much a generalist. But a lot of the research has been focused on those kind of three areas. But yeah, I do cover IT. The thing I would say though is consumer discretionary, IT, well, IT to a degree, but especially consumer discretionary, it requires a lot less expertise. That might sound like an insult. It's not meant to be, but oil and gas is a very complicated industry to analyze for a beginner. Same to a degree with minerals, like mining companies, because they are just a totally different beast from, retail. A lot of people know that the average person understands the business model of a retail company, right? Yeah. We all understand how stores work. Mining and oil and gas are a lot more complicated. There's a lot of these procedures in terms of, how much oil they produce, how much their reserves are in terms of their size. So it's a lot trickier for a beginner to analyze those industries. So I've definitely researched retail companies and other. I actually did a big report on utilities not too long ago. Yeah, I'm a generalist. I guess the more I talk about it, the more I realize I'm a generalist. But I would say that I've spent the longest amount of time honing my understanding towards oil and gas because it was such a tricky area to understand, and finances, including insurance companies, because they have, to that same point, complicated accounting rules that actually just changed in Canada. So there's a lot to look at there.
But okay, what I really like here is that I can now ask you a macro question. Sure. Because I don't know too much about, I'm also a bit of a generalist, but I don't know too much about how the oil and gas industry actually works. So what do you see? Because that's now an industry that's in huge turmoil. So what's going on there? Do you know? What's your assessment of, the oil and gas market at the moment? There are two different things already, I guess. But
yeah, so it depends. To look at Canada specifically, we have a very, I don't want to say unique market, but a lot of our companies are constrained heavily by infrastructure. So things like pipelines were very political in Canada, and because of that, there's basically no new capacity coming with pipelines. So what we have is what we've got. So a lot of success in oil and gas is tied to the efficiency of oil extraction. So whether your reserves have easy to access and economic oil, and there are a whole bunch of different variables there in terms of how much oil is in the ground, how much it produces in terms of effort that you put in, and the netbacks and things like that, which is kind of your profit margin on that. So outside of
what do you mean with netbacks?
Sorry, netback is the profitability per barrel of oil. So think of it as like net income per barrel. That's not fully accurate, but that's kind of what it means. So outside of that, so there's extraction, there's transportation, and then there's where you sell it. And those all matter quite a bit. So transportation is important because if you're close to a pipeline, it's a lot cheaper. But you also have to make sure that that pipeline is willing to give you capacity, because at the same time you're there might be 3 other companies also trying to use that same pipeline. So that's another variable to consider. And then there's where you sell, because technically Canadian oil could be shipped overseas and maybe earn a higher premium. A lot of it is just sold to the US. And actually, Canadian oil sells at a discount to U.S. oil.
Really?
Because there's a big there's a big advantage to demand, a lot of buyer power, because we have really one big customer, which is the United States. And the United States has a lot more infrastructure for oil and gas movement than Canada does. So one of the big political issues was Canada was trying to, I think it was actually natural gas, which natural gas is very similar to oil, because at the same time you extract oil, there's a lot of natural gas in that same reservoir. So a lot of companies will make both. Canada was trying to ship the natural gas and possibly oil to its west coast so that it could then sell it to Asian countries and different markets out that way.
Yeah.
And it got canceled, basically, was so that's the tricky thing with Canada. It's
But why did it get canceled?
Political issues. So environmental concerns about there were rare killer whales that lived there and things like that people were worried it would disrupt and it's not to say that those concerns aren't valid, but obviously it led to this economic limitation, if you will. So all to say, it's a very tricky area to navigate naturally, because you have these three important variables: how well you produce it, how you transport it, and where you sell it, that are often very constrained by which land you owned, the infrastructure you have, and the markets you can actually access because of that infrastructure. So it's a lot to consider.
And that's important, for example, for me, like if I want to invest in oil and gas and I'm seeing, hey, oil and gas prices, well, especially here in Europe, are insanely high. So I'm going to go invest in Canada, but it could be that Canada is not the best position to take advantage of that, for example, and the US gas, at least, market is fairly much more isolated than many other gas markets, and then that's a good way to get burned as an investor, right? If you don't do the research, then
if you don't understand how the broader market works, and things like infrastructure, for example, like you could find a company that's advertising, hey, we make the most oil at the cheapest price. It's like, great, I'm going to buy that company. Well, maybe they don't have infrastructure, and maybe they have to use trucks to transport all their oil, and maybe that's very expensive to do so. So that's why it's important to understand those three variables. And then on top of that, you have the demand side of it, right? So that's just supply. On the demand side of it, it's, are people even willing to buy oil? And when you have a pandemic, for example, we saw oil prices go negative because there was a period of time where, at least investors, it's important to remember that was a futures contract, not a specific barrel, for example. But still, to say that people didn't want barrels for a period of time. So it's like any commodity business. It's really it's a tricky area, because not only do you have to have a good business, you have to have a good price, and you don't have a whole lot of control over the price of the thing you're selling. So compare that to like a tech company, like, again, not recommending any businesses, but like Apple, for example, which you could argue has a very strong brand position and a lot of price power. Obviously, they're in a much better situation to earn hefty profits versus an oil and gas company, which 2 years ago was losing money, now is making a bunch of money because oil prices are higher. Who knows where they'll be a year from now? So it's a really tricky area.
So fundamental investors watching the stream, start with tech, and then only when you're advanced, like Richard, you have seen 100 Plain Bagel videos, can you move to oil and gas and commodities.
Sure, yeah. I don't actually cover industry-specific stuff, but it's kind of like the same position I take with individual stocks. I don't want to talk too much about individual sectors because I don't want to encourage people to invest in different areas, but for sure it's
no, but I think we've given a disclaimer. We've said already, for investment, it doesn't matter at all how good a sector is doing. It only matters how good it's doing compared to its price. And so since we've said nothing about the price, they shouldn't have anything to make investment decisions on, with you talking about oil and gas now, right? But I'm just saying that because I wanted to ask you one more question about oil and gas.
Sure, yeah, that's fine.
I'm trying to cover you. But no, because So I was wondering, so about this market, 2014, 2015, like you mentioned, was crucial for this whole market, right? In the sense that they had the shale discoveries in the United States. This is when people started talking about the end of the peak oil, and sort of can Saudi Arabia even, break even as a country with their budget. And as I understood it, the price crashed, and then what we're dealing with partially now, but please correct me if I'm wrong, is a long period of underinvestment, and shale apparently cannot scale up as fast as we would like now that Russia has cut off a lot, or we have cut off Russia, whoever did it.
Yeah, whichever side.
Can we scale up, Richard? Because I need to survive this winter.
Well, that's the thing, right? Is I went to this presentation from a big Canadian oil investor advocate, Eric Nuttall. And he kind of argued that, no, we can't scale up very quickly. He sort of divided into, if you look at super majors, so Occidental, Exxon, and like those bigger oil producers, a lot of them with international presence are very hesitant now to scale up production because they were burned by that time period.
Yeah.
And a lot of them are trying to navigate the renewable side of things of, we're going to pivot. We're going to eventually become a green producer, and we're going to invest in renewable. So because of their publicity, I guess, almost, a lot of the companies are shunning basically new projects for oil, at least large oil expansion, even given the current price, because they know how fickle that can be. And I believe I might be misquoting him. And again, this is an analyst who really likes oil and gas, so take that with a grain of salt. But I believe he, specifically Canadian oil and gas, so, he's obviously going to argue that it's harder for competitors to do well. But I think he argued something along the lines of that it would take them, even if they wanted to expand into oil, it would take them to build the infrastructure about 4 to 5 years to get oil out of the ground for a project that's already been planned out for them. So it takes time to build up the infrastructure for an oil and gas well, right? Because it's not just building the infrastructure; it's actually testing the ground, finding where the oil reservoir is located, and the most optimal place to put your well to extract that. There's a lot of engineering that goes into it. So on that side of it, it's going to take some time for the supply side to scale up. There are countries, Iran is another one that is a big oil producer that is facing sanctions.
Yeah.
Some people believe that they're already selling oil through the black market. You could read some articles about satellite imagery showing barrels of oil being placed onto cargo ships. But all to say that obviously there's some who believe that they might be able to fill the capacity gap because they're a big producer. Problem is they're not on very good terms with the U.S. And their oil has basically been shunned by a lot of the developed world.
Yeah.
And then there's Canadian producers where even though Canadian producers might be in a better position, and this probably applies to U.S. producers as well, not specifically shale, because shale is very difficult to attract investor money, even though they can very quickly seemingly grow production.
Yeah.
They also have very slim margins. So that's the thing to consider.
But even now, with prices this high, why can't they scale up now and get a nice...
It's not... They would make money at this price. It's to say that investors aren't willing to take the risk.
Yeah, okay.
That's kind of... It's sort of like a muscle memory thing, where it's the same reason why after 2008, you probably didn't have a whole lot of investors... housing in the U.S. didn't have a whole lot of supply for a while, where a lot of home builders... Even though prices might have started to recover, it took them a very long time to start building houses. And even to this day, if I'm not mistaken, home building activity in the U.S. is still below 2008 levels. And prices have increased quite a bit, possibly as a result of that.
Yeah.
So a lot of that aspect is just, it's the same thing as the super majors. There's this pain behind it that's investors don't want their money going into the development of that stuff, whether it be for green reasons or just financial reasons that they lost a lot of money during that period of 2015 to 2018 roughly, when that glut happened. So that's the problem with, even though we have this, call it a perfect situation to build something in the short term anyway, in terms of if you were able to sell oil today, you would make a lot of money. A lot of people just aren't willing to take the risk thinking that if oil prices were to normalize 2 years from now, it's tricky too. If you build infrastructure that takes 5 years, but California is banning gas vehicles in 2035, well, that only gives you if you extrapolate, California is a rare case, but if you extrapolate that and say people are going to try to cut down their consumption, a lot of people don't want to invest in a short-term project that takes 5 years to build. So supply constraint is definitely a big variable and a big part of a lot of investor theses around oil and gas.
Okay. So if I can tie it a little bit to economics, I'm definitely hearing you talking about at least two more important concepts. One is the hog cycle, and that refers to something that economists first sort of saw in the market for hogs, so that is pigs, and that is basically that in any market where there's a delay between sort of investing and producing, you very quickly get cycles, in the sense that if the price of hogs is really high today, you're going to be breeding hogs, but it takes a while for them to grow up, and then so everybody is breeding for more hogs, and then you automatically, sort of naturally, instead of sort of the standard theory markets are stable, you get cycles. Is that model applicable to a lot of commodities as well?
I would say so. I mean, at the end of the day, the vast majority of commodities have quite a bit of lag time to lead to production, and that applies to mining, that applies to oil and gas, really any kind of commodity. When you think about the process involved with it, and even outside of extracting it, oil and gas, a big part of it is refining as well. Refining is a big function of oil and gas, and there's also a shortage of refineries in some places. So obviously we can't stick black crude oil into our cars. It needs to be refined, and different byproducts need to come of that. So there's a lot of so all to say that, I think this cycle approach makes a lot of sense. And we saw that with the glut as well, right? There was a period where prices were, call it, stable. So all these shale producers built, and then the price collapsed because of that. All these companies exited. Now the prices recovered. Companies may, and we are seeing, there are Canadian companies, for example, acquisition activity has increased a lot. So companies are once again willing to, because it's harder to build the infrastructure, they'll just buy smaller competitors as opposed to building more infrastructure. At a net basis, though, there's this reluctance to build net capacity, I guess, because at the same time, politicians are fighting for better or for worse. I'm not against green initiatives. I think obviously we need to make some progress there, but a lot of these companies and the governments that they operate under have a reluctance, right? It's not a good look to say, okay, we're going to invest all this money into oil and gas, and the Inflation Reduction Bill from Biden focuses a lot on, or at least has a bit in there about electric vehicles. It's not to say that that's a bad thing, but it's to say that there's this, on top of the cyclical nature of the industry, you also have secular trends, right? About whether oil and gas probably 10 years from now won't be, I think actually peak demand is forecast by some to be around 2035 to 2040. Okay. So who knows where we'll be in 20 years, right?
Yeah.
It's all to say that a lot of countries are trying to future-proof their investments, and oil and gas probably doesn't look like all that attractive to be future-proof.
Yeah, but one thing that you mentioned was interesting to me. You said, okay, a lot of small parties have been bought up by large competitors, and this I can link to. I saw someone in the chat mentioning, because this is it said, honestly, they want more money for the oil. It's the power of monopoly, and this is very much sort of the concentration of power in certain markets argument that's being also made a lot in relation to inflation. And since now a lot of inflation, particularly in Europe, is in the energy sector, is that also a part of it? Is that fair to say? Because go ahead.
In terms of politicians wanting power in oil and gas production, is that what you mean? Or
no, so this user DTYIIG, and I'm not sure how to pronounce it, is basically saying that the companies have monopoly power, and so they could scale up production if they want to.
I see. Yeah, so I would say that, I mean, if you were to say, well, what did a company learn from the oil glut from a few years ago? I'm sure there are companies out there that say, hey, we have the capacity, we're not going to, because why would we? We don't want to. And OPEC to some degree kind of exemplifies that. And there are some who question whether OPEC could drastically expand production, or if maybe they're already kind of close to that limit, if you will. But at least in terms of their messaging, they've refused to fully open the floodgates, if you will, in terms of oil supply. So for sure, I think there's that aspect to it. Suppliers are trying to keep their supplier power, their newfound supplier power, if you will, by limiting supply. And but then you kind of get into that Nash equilibrium side of it, right, where you might have a company that says, well, I'm going to be the one that expands production. And I think for sure, if you would have a period of time where, say, $100 a barrel was sustained for, say, several years, you would see the production pick up. I think there's no doubt about it. OPEC has itself even struggled to maintain price, obviously, over the last few years, price stability. And that's a formal organization whose sole objective is cartel.
So objective
but
to fix
the price.
One,
a formal one to try and fix the oil price. And they've largely failed at that.
But doesn't that go against sort of the hypothesis that it's big oil companies that do this? Because I'm not sure. So this is a camouflaged question. We tend to think of these oil companies as big, powerful, like Exxon, Shell, right? We think they're some of the biggest companies in the world. But do they actually have the pricing power in this market, or are they actually relatively small compared to national players?
I would say, I wouldn't have the numbers to, prove that. Say, like I wouldn't know what supply of oil comes from, say, Shell or one of these companies specifically. I would say that they probably have more supplier power in this current environment than they might have had, even just a few years ago. Especially with, you mentioned Russia. When you have this big world power pull out their oil supply, heck, you're in a much better situation. And hey, maybe you don't bolster production right away and you just reap in the profits. I do think it has more to do with their kind of investor focus, if you will. A lot of oil and gas companies have had very depressed valuations for quite some time. And actually, this is a point that Eric Nuttall, again, that very pro Canada oil and gas investor, what he made in his presentation is a lot of companies just think that they'll get better returns on capital returning money to investors as opposed to just building more production, because at the current level of production, so you could say it's that keeping the supplier side of it. But I think companies like Shell are more so worried about what do our investors want and how do we appeal to that. And I think a lot of the answer for the super majors is, well, we're going to invest more in green initiatives as opposed to building out our supply, because their stock price was punished for quite some time for being in oil and gas. So I think it has, I would speculate, this is total speculation, but I would speculate it has more to do. I would guess it has more to do with that side of it, because these stocks, at the end of the day, they do want their valuation to increase. And when you have companies like Tesla and green style companies earning a stock premium because they are green focused, even if they aren't as profitable, these companies get sort of a valuation premium to them, whether it be renewables, renewable utilities, whatever have you. So I think companies like Shell look at that and they think, well, geez, like if we want to see our stock price improve, we're going to expand our renewable and our green presence. And, to some degree, there's benefit in that. And, a big part of our transition is going, a lot of people, they take an all or nothing approach, just like investing, I guess, where it's all or nothing. It's either we, go all green investments tomorrow or next year, or the world ends. And, there is a need for aggressive investment in green. But I think oil and gas, contrary to what a lot of people believe, is going to be around for quite some time. And I think transition investments are going to be important. And transition technologies and things like carbon capture and things along those lines are going to be very important over the next decade or so. Again, my opinion there, but but to say that, I think that's where a lot of these companies are going to focus a bit more on in the near term, is trying to offset their carbon footprint and things like that, because that's what draws investor attention.
Yeah. Yeah, yeah, and from the perspective of the energy sector, this whole oil is expensive again, and we want more oil, and especially gas is a super new thing, right? So it will take a lot of time for them to maybe even mentally adjust to that.
Yeah, there is a muscle memory aspect to it where, if they've been burned, like I said, home construction in the U.S. is a perfect example of that, of when, investors, they remember the pain they felt. And after seeing the collapse of different oil and gas companies and the price of oil, they're probably going to be reluctant, at the very least, to see how long those prices are sustained, right? A blip in oil prices isn't going to lead to a surge in investment. It's going to take time for, call it those old wounds to heal, and for people to forget about that and to be, not to be too, righteous, but blinded by greed, I guess. Oh, well, I don't like oil and gas, but geez, they're making a lot of money. Now we'll boost production or whatever have you.
Yeah, I guess a bit similar to how sort of crypto collapsed, and people thought, well, it's going to be a while until we didn't see the next bubble. But when the returns are so good, people happily get back into it.
Yeah, that's it, right? It's the allure of the financial markets, and kind of why we have bubbles is you can fight against something as much as you want, but if you see people making money with it, I know people who don't believe in Bitcoin who still purchase some of it. Like, it's, at the end of the day, you might know the game you're playing, but you still see it's still very hard to look away from that attractive.
Yeah, and then I think that brings us back to sort of what we talked about before, where you have a fundamental investor, but a fundamental investor can also look at what other market participants are doing and anticipate those, and try to play the game of both the chartist, maybe, or momentum investor and the fundamental investor for optimal returns.
Yeah, I think, even though I'm a fundamental investor, I think it's important. Like, a balanced view is always the best thing, right? To consider the technical side of it, the quantitative side of it, and even with cryptocurrencies, like, I'm not an enthusiast myself, but I don't want to be blind to stuff, and that's kind of the end of the day. I recognize my own limitations, and I'll read about all different types of things, even stuff that might be opposed to my own approach to investing, because at the end of the day, we're all human. We all have our own biases and limitations. And I'm sure you see in economics too, you have people who subscribe to different schools. Usually a good approach is to listen to both schools of thought and to try and come to some balanced reconciliation between the two.
Yeah, and I think more people I'm even if we get back to our discussion about the state of YouTube finance, actually I'm surprised sometimes to see so many people who really disagree with me, especially on monetary economics. So maybe they're more on sort of, hey, money is a commodity, Bitcoin is the next money, blah. And they still watch a lot of my content, and that is just, I think, the best thing that I typically see, because then I'm thinking, okay, but this is great because you disagree with me, you still watch it because you want to not be caught in your bubble.
And
which gives me hope.
There's a I like to say debate is the path to truth, and I've always thought that with even my channel. It's not to say that you can't, you can have your own beliefs, and you should hold your own beliefs and argue against ideas you don't believe in, but debate is important, and I think if you can do that in a healthy, not aggressive environment where it's just name calling and straw manning people's arguments, which I think happens a lot, even in economics. I'm sure you see a lot of people probably have called you a Federal Reserve sleeper agent. I'm sure. So
yeah, and I'm also a CCP sleeper agent these days.
Oh, cool! Both nice.
Yeah. I work for all countries.
Nice. Yeah. So I mean, I think if you can avoid that stuff, which obviously that's just a non-starter for discussion, for healthy discussion. I'll talk to people who are really into crypto and have those debates, because I think it's important. That's how you find out what you're missing and things like that. So, I encourage that stuff, and I actually quite like when people have constructive criticism, not necessarily negative, insults, but I quite like constructive criticism, even if it's on the subject I'm discussing, because that usually prompts me to think, oh, well, maybe I am wrong about that, and I'll go look into it and maybe learn something about the topic. So it's but yeah, it's a tricky space on finance YouTube, especially economics, because it's such a politicized issue too, right?
Yeah.
Talk about money printing. the concept of money printing, I think it's probably one of, I think I asked you when you were on my podcast what was the most misunderstood thing in economics. My thought would be money printing in the current environment. I think, to your point about accounting, I think the base level is, if you realize that banks are giving like money asset for Federal Reserve bank reserves, you kind of get a better understanding, whereas a lot of people oversimplify it as, well, it's just banks get free money and that's why we have massive inflation and things like that.
Yeah, and that will really burn you, not always, but I think a lot if you're an investor as well. Like, for example, the United States was the country that printed the most money, in the sense that it did the most stimulus, and yet the dollar is the currency that came out on top over these last few months.
It's kind of funny, not to I'm not going to name names, but there's one YouTube video I saw of
name names, Richard.
No, I'm not. I don't want to. The thing is, I never want to be jaded or try to go after people. I'd rather have a positive discussion and discuss what I believe and what I think. Highlight the people with good education and good experience, such as yourself and your channel, where I think you do a really good job. As opposed to, I'll give my criticisms, but I'm not going to punch someone down, I guess. But there was one video I saw that it was like a YouTuber interviewing, he said financial experts, and it was basically other finance YouTubers, and nothing wrong with that. But money printing was the main thing they all talked about, and I almost wonder if any of them had that background and understanding of what that concept actually is, because I think if you watch a lot of YouTube videos and things like that, money printing is going to be painted as one way, whereas if you talk to academics and economists, it's going to be painted another. So it's a tricky space, and that's why I think, and to your point, I think you should get professional education or explicit education around accounting. Economics probably helps too, because I think it's good to get that information from a not so politicized source, hopefully.
That makes sense. I think that's a really good way to round off our conversation, in which we have covered a ton of topics. I especially really enjoyed learning so much from you about the oil and gas industry, which I didn't know too much about. So this ended up being also a lot. Joeri learned macro from playing Bagel, or at least industry level macro.
Yeah, it's a good, and again, I'll say it again as my final disclaimer, I'm not recommending any particular sector or position investments. It's just, you could assume that I'm analyzing an industry. Maybe I came to a sell or a buy recommendation, but that's kind of, it's an interesting area though. And oil and gas, we like to assume that it's a dying industry. Maybe it is, but it's still such an important commodity. It's really hard to ignore that.
Yeah, exactly. And then I really liked how you tied it to being a fundamental value investor, but also taking into account chartists, or that's how an academic would say, what you would say, technical traders. Sure. And I hope that we've also highlighted, at least have a look at the basics of macroeconomics if you want to invest, like money printing, other monetary policies, exchange rates, and business cycles. Hawk cycles is something we talked about.
I hadn't heard that term before. I've heard business cycles, but I hadn't heard hog cycles. That's really interesting. But
yeah,
no, it's a great analogy.
Yeah, I definitely recommend anyone to Google that. But let's round off this conversation by you taking one final question from the audience. How about that?
Sure. Okay, you want me to pick one?
Yeah, for sure.
Geez, let's see.
Or maybe we should ask them to submit a question.
Sure.
Because I think there's
someone
a lot of discussions.
A really good closing question. No pressure.
And it will take some time, because there's typically a small delay between us talking and people. So this is also one thing I really enjoy, sometimes looking at the chat. So now this guy or girl, not real, says, "I love pro-China content."
We didn't even really talk about China.
We didn't. That's true.
That's the problem with YouTube, though. It's, yeah. I mean, like, you see that all the time. And that's I think one important approach is with comments. You try to take the feedback that's genuine, and you got to build a bit of a you got to be able to filter through stuff as well.
Yeah.
Okay, here's one question from JP72. I haven't read this question yet, so I'm reading it live. Will this change in a rising rate? Oh, maybe I missed something.
Oh, they're referring to someone else, I think. Simon
Okay,
Person.
Okay, sure. Let's go with this one. Chantel Kulzma says, "What if you don't want to invest in oil due to ethics?" All the power to you. I would say is like I said, it's not a recommendation about which industries you should invest in. I think it's within ESG, which is environmental social governance, kind of a broad-based term. It's important to recognize the limitations of that term because a lot of people, there are oil and gas companies that are classified as ESG, so take that with a grain of salt. But you should invest in areas that you feel comfortable in, that you have if you're buying individual stocks, that you have a core competence and understanding, and things like that. So there's no pressure there's other opportunities in the stock market, and it's kind of like what I said earlier, that our company, for example, weights between different industries. We don't go all in on oil and gas, or we don't go all in on tech. There's plenty of opportunity in the stock market. It's not just within singular industries. So if you don't want to invest in a certain sector, all the power to you. That's your own money. That's a free market, baby. To put your money where you want to.
And there's still a lot of opportunity in renewables as well, right? Like solar panels, heat pumps are super hot.
Yeah, and renewable utilities. There's all kinds of companies, and if you even within oil and gas, you might not like that sector. There are companies, again, that have an ESG label. Companies that there are companies that have net negative carbon emissions, where at the very least they either through investment, the purchase of carbon credits or whatever have you, offset the majority of their production or more than what they produce in an attempt to be a green company. So there's a lot of room within that framework if you still want to take advantage of that, but have this ethical dilemma, if you will. But invest where you want to, invest. And I think it's important to invest in where you have values, because otherwise you're kind of just speculating, really, right? If you want to invest in something for the long term, but you don't believe in it ethically, you're kind of not really believing in that company. And I think one way to reconcile ethics with investing, because I know a lot of people, they take a very cold-hearted capitalist approach of, well, if it makes money, like, who cares? At the end of the day, you can have your ethics and I'll have my money. I think ethics are actually important to consider in the sense that it's a risk to a company, just like the super majors are showing us. If investors believe that something is unethical, they might pull investor money from that company, and that will have a real fundamental impact on that business, even though they're making money. So I think you can consider ethics in your investment framework from a risk side of things, of, if something's unethical, it's actually a higher risk position, in my opinion, not just because of investor pulling back money. You might see regulation. Certainly with oil and gas, that's been a big headwind for some companies. So there's certainly ways you can reconcile that, but absolutely, you don't need to, you don't have to invest in oil and gas.
Yeah. All right. With that all being said, I think it's time that I head into the garden to enjoy the last summer sun with a nice glass of tea. And I think you have to get back to work.
Yeah, I have to get back to work, yes.
Although I'm super honored that you took time out of your workday to talk to us about money and macro.
My pleasure. Thanks for having me on. It was a really fun conversation.
Thank you, Richard. And for anyone who hasn't subscribed yet to the Plain Bagel, although I don't think there are many, do so. I mean, you see that Richard is a very ethical and careful educator and investor from whom you can learn a lot.
Thanks, sir. I appreciate that. I try my best.
And he's very modest as well. All right. Thank you so much. Take care, everybody.
Bye, Joeri. Thanks to everyone.